Hello, welcome back. Time to talk about another stock that has been severely beaten down and it has just reported earnings. It was 14% down today during the crash, the massive crash that happened in the markets today, where the Nasdaq lost like almost 6% or close to that. And right now it's actually down almost 10% after hours, after reporting earnings. And let's see what happened during these earnings. This is a company that I have examined in the past, and I told you back then that it was very overpriced, but we're gonna look at what it's been going on recently, and whether now, after all this massive decline, is a good time to buy some of its stock. Now, you will see here that reports slightly better than expected results for its fiscal Q1, and the company says it might remain in loss in the current quarter. And also the shares of this company tanked nearly 20% at some point in extended trading. Absolutely insane. Now you will see here that the company lost 41 million in the first quarter versus the year ago figure of 40 million. A little bit of a steeper loss here, but not insane. And per share loss of 13 cents, pretty much unchanged on year over year. Adjusted per share loss came at 1 cent, and revenue jumped 54%, which is the good thing. But consensus was for break-even on a per share basis, back on 205.7 million in revenue. More customers as well, over 14,000 new paying customers. Now the future guidance, as you'll see here, is that in Q2, Cloudflare expects revenue to fall between 226 and 227, pretty much 0.5, and it hopes to break even pretty much in the current quarter, or again report an adjusted per share loss of a single cent. So basically we're looking at pretty modest guidance here, pretty much a little bit disappointing, but you will see that the company has been annihilated after this kind of report, even though it's kind of average, to tell you the truth. Now if we take a look at the max chart, you will see that the company has been in a massive decline, as most tech companies right now. $221, 64%, 65% down from its 1 year high. Absolutely obliterated, and it will open up even lower, $70 over here. We're probably looking at a 70% loss overall, if not more actually. Okay, but look at these numbers here. Everything negative, minus 111 P ratio, negative P ratio all over the place, negative price to free cash flow ratio, a lot of extra outstanding shares because the company has been diluting shareholders like crazy. This is a failure waiting to happen for an investor who is getting shares all over the place here. And this is what I try to help investors avoid with my channel. If you kept buying at these levels, it was a very bad idea. Again, based on the company's financials, this has nothing to do with the stock price. It only has to do with the financials. Because just by looking at these three things here, I would be out before they blinked, actually, if they asked me to buy this one. It's just too obvious that this is not going to end up well. Now the free cash flow is negative as well, so this is why this is negative too. The only interesting thing and good thing is the revenue growth, but you will notice that even at these very low absolute numbers, we are not increasing our revenue in an insane amount. This is like 5 years also, and the net income is still negative, and the free cash flow is also negative. And the total equity is growing, but why? Of course, we know the drill with these kinds of companies. Outstanding shares, they are funding themselves through investors. Okay, negative net income, of course, and negative returns over here, all over the place. Pretty terrible stuff. Okay, if we take a look at the financial statements here, you will see that, the company has been growing the revenues 100 million to 650. But if you go down, you will see that the net income has been going negative pretty much. Even though revenues have been increasing, net income has been decreasing the same way as the revenues grow positive. Negative net income has been growing negative as well, and so that's a bad thing to see. Now the balance sheet, of course, has been getting better because of additional paid-in capital. Company has been issuing shares like crazy, new investors coming in, buying that junk, and pretty much adding some money to the stockpile, to the bank basically for the company. And you will see here that their total equity has been increasing. So from having negative equity to having close to $1 billion of equity right now. And the cash flow statement, negative net income, that translates to a little bit of a positive cash flow because of the magic that the stock-based compensation and depreciation amortization is. But practically speaking, we are talking about cash provided by operating activities, which is not really coming from profitability. And the other thing, net cash from investing activities, negative as well. That's a good thing, of course, because the company has been purchasing investments. So this company is acting like they are a hedge fund. They are basically selling you shares of their company, and then they go off to the secondary market. Then they are buying other investments. So they cannot really make money from their operations, but maybe they can act as a hedge fund and make money from your investment at this company. So be careful. And in terms of financing activities, this is very positive here, meaning that the company is getting tons of debt. 1.2 billion here, 500 million. Getting more and more debt is the story here. And a little bit of cash here, pretty much very little cash overall. Okay. And what about the free cash flow? Used to be negative slightly. Oh, no, this is also negative over here because of capital expenditures. Yeah, the capital expenditures are pretty sizable here, and so eventually we're getting negative free cash flow as well. And if we take a look at the stock evaluation tool, we are pretty much having nothing to work with. We can of course go very, very high in revenue growth. Let's just say we go 20, 22 and 24, and we're convinced that the company is gonna be increasing the revenues tremendously. The problem is, what are we doing with the net income? Like their margins have been negative all over the place, and their best year was 5 years ago. Since then they have been doing worse and worse, with some a little bit better years, but still very far from profitability. So this is a company that I would probably not even look at for this kind of stock evaluation tool here. But let's just say that it becomes marginally profitable, and I'm just adding three values here: 1, 3 or 5% in terms of marginal profitability. Now the free cash flow margin, you will see these high values here, but remember, free cash flow and net income is negative, and so this kind of free cash flow margins here are not to be taken into consideration. However, we typically want something like 70, 80 or 90%. That would make sense. And an annual return of 13%. We hit calculate, and we'll see that this company, I mean, using a discounted cash flow model, is probably not worth anything, because we just can't see when and how they're gonna become profitable. They look very, very far from achieving profitability. And as I mentioned earlier, you can look at the revenue in the year 2017 and the year 2021, and you will notice that the net income has been, there's an insane disparity in the negative. So even though the company is making much more revenue, even five times more revenue, they are still losing tons of money. And while they could be doing it in some sort of strategic way, I would prefer them to use their money instead of like investing in other stocks and other securities. Just try to get into profitability, because again, I don't want to be buying a company stock and then have them act as my hedge fund, because I can do that on my own, or maybe hire another hedge fund if I wanted to. So that's not great for me. And you're getting a very, very low value here because of marginal profitability. And even this is a little bit aggressive, because remember, their net income margins are very, very negative. They're not even close to profitability. And this is why you are getting a very, very low number. So this is a company that I would stay away for sure. I think they would have to do much better in the short term for me to potentially even think about adding some money here. And they would have to be much closer to profitability. And I would probably want to see that happening for a couple of years or so, because they are not convincing based off their numbers here, based on their numbers. So yeah, that's what I wanted to talk about in terms of this company. Tell me what you think about Cloudflare. Do you think it's a potential interesting investment? And let me know why you would think that, and whether you are thinking of actually holding the stock. And thank you for watching the video. I hope you enjoyed, and if you did, please leave a like and subscribe. I'd love to see you around. And remember, you can always get access to this tool by becoming a Patreon. You can find all the links in the description box below. And thank you for watching this one again. Have an awesome day. Bye bye.